Assets. Imagine you own a home worth $300,000, have $15,000 in a savings account, own a car valued at $25,000, possess $50,000 in retirement investments, and your small business owns equipment worth $100,000. All of these are assets, things you own that have economic value. If you sold everything, you'd have $490,000 before paying off any debts. Assets represent the resources you control that can provide future economic benefit, whether through use, sale, or income generation. An asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide future benefit. Assets represent claims to future cash flows or utility or value and appear on balance sheets as what an entity owns. Its fundamental characteristics for something to qualify as an asset typically must be owned or controlled by the entity, resulting from past transactions or events, and provide probable future economic benefits. The asset must also be measurably in monetary the asset must also be measurable in monetary terms with reasonable reliability. The major asset categories are current assets or short term, resources expected to be converted to cash or consumed within 1 year, cash and cash equivalents, the most liquid assets, including currency, checking accounts, and money market fund, accounts receivable, money owed by customers for goods or services already delivered, inventory, raw materials, work in progress, and finished goods available for sale, marketable securities, stocks, bonds, and other investments easily converted to cash, prepaid expenses, payments made in advance for future services like insurance and rent, non-current assets, which are long-term assets, resources providing value beyond 1 year, property, plant, and equipment, PP&E, land, buildings, machinery, vehicles used in operation, intangible assets, non-physical resources like patents, trademarks, copyrights, brand value, and goodwill, long-term investments, stocks, bonds, or real estate held for extended period, and natural resources, oil reserves, mineral deposits, or timber rights. So what's the difference between tangible and intangible assets? Tangible assets have physical form you can touch: real estate, equipment, inventory, precious metals, artwork. These often depreciate or lose value over time through wear and obsolescence, except for land and certain collectibles. Intangible assets lack physical substance but can be extremely valuable. Coca-Cola's brand name, Microsoft's software patents, and Disney's copyrights are worth billions. These assets may have indefinite lives, trademarks, or defined periods. Patents typically last 20 years. Goodwill represents the premium paid when acquiring a company above its tangible net worth, reflecting brand reputation, customer relationships, and market position. So, how has asset accounting historically developed? The concept of systematically recording assets emerged with double entry bookkeeping, documented by Luca Pacioli in 1494. This revolutionary system required every transaction to affect at least two accounts, with assets balanced against liabilities and equity. The Industrial Revolution necessitated more sophisticated asset accounting as factories, machinery, and equipment became central to business value. The concept of depreciation, or systematically allocating asset costs over useful lives, became essential for accurately measuring profitability. The 20th century saw growing recognition of intangible assets' importance. When Philip Morris acquired Kraft for $12.9 billion in 1988, 4 times its book value, most of the premium represented intangible assets like brand value. This highlighted how traditional accounting often understated companies' true worth. The technology era further emphasized intangibles. The technology era further emphasized intangibles. When Facebook acquired WhatsApp for $19 billion in 2014, it bought essentially no tangible assets, just intellectual property, user base, and potential. Modern accounting standards have evolved to better capture these realities. So, what are the asset valuation methods? There's historical cost, recording assets at original purchase price, the most objective but potentially least relevant method for decision making. Fair price market value, what a willing buyer would pay a willing seller, used for investment and requiring periodic reassessment. Replacement cost, what it would cost to replace the asset today, relevant for insurance and management decisions. Net realized value, expected selling price minus costs to compete and sell, used for inventory valuation. Present value, future cash flows discounted to today's dollars, used for long-term receivables and certain investments. Different assets use different methods. Public companies' investment portfolios are typically marketed to market or fair value, while buildings usually stay at historical cost minus accumulated depreciation. Depreciation and amortization. Physical assets, except land, typically decline in value through use and time. Depreciating systematically allocates this cost over the asset's useful life. A $100,000 machine with a 10-year useful life might depreciate $10,000 annually using straight line depreciation. This serves multiple purposes: matching expenses with the revenues they generate, or matching principle, reflecting economic reality as an asset wears, accelerated depreciation methods, front load deductions, benefiting companies' cash flow through tax savings. Intangible assets with finite lives undergo amortization, conceptually identical to depreciation. A patent costing $1 million with a 20-year life would amortize $50,000 annually. Asset classes for investors. There's equities, stocks, ownership stakes in companies historically providing highest long-term return with significant volatility. The S&P 500 has averaged roughly 10% annual returns over the past century, though individual years vary dramatically. Fixed income or bonds, debt instruments providing regular interest payments, generally lower risk and return than stocks. Government bonds are typically safest. Corporate bonds offer higher yields with increased risk. Real estate, property ownership or real estate investment trusts, providing rental income, potential appreciation, inflation hedging, and portfolio diversification. Cash and cash equivalents, savings accounts, money market funds, certificates of deposit, providing liquidity and capital preservation, minimal return. Commodities, physical goods like gold, oil, agriculture products, often serving as inflation hedges and portfolio diversity. Alternative investments, hedge funds, private equity, venture capital, collectibles, art, wine, classic cars, and increasingly cryptocurrency offer potential diversification, but usually requiring significant capital and carrying unique risks. Asset allocation. This investment strategy divides a portfolio among different asset categories to balance risk and reward based on goals, time frame, and risk tolerance. A young professional might hold 80% stock and 20% bonds, while a retiree might reverse this ratio. The principles of diversification, not putting all eggs in one basket, reduces portfolio volatility because different assets often move independently. Modern portfolio theory, developed by Harry Markowitz, Nobel Prize 1990, mathematically demonstrated how combining assets with different risk return profiles could reduce overall portfolio risk while maintaining expected return. Liquidity. Assets vary dramatically in how quickly they convert to cash without significant loss. Cash is perfectly liquid. Publicly traded stocks can be sold in seconds. Real estate might take months. Ownership stakes in private companies could require years. Illiquid assets typically offer high expected returns as compensation for this constraint. Productive versus non-productive assets. Warren Buffett distinguishes between productive assets, farms, businesses, rental properties that generate ongoing output, and non-productive assets, gold, collectibles, that rely solely on finding a buyer willing to pay more. He strongly prefers the farmer, arguing productive assets create value while non-productive ones merely transfer wealth between buyers and sellers. Liabilities and net worth. Assets must be understood in relation to liability or debts. A $500,000 house is less impressive with a $450,000 mortgage than with no debt. Net worth equals total assets minus total liabilities, the true measure of financial position. Wasting assets. Some assets inevitably decline to zero value. Leases, patents approaching expiration, natural resources being extracted. These require special consideration in valuation and financial planning. Digital and cryptocurrency assets. The 21st century introduced new asset classes. Digital assets include domain names, cryptocurrency, NFTs or non fungible tokens, and virtual real estate in online worlds. Bitcoin, created in 2009, has grown from worthless to a market capitalization exceeding $1 trillion at times, though with extreme volatility. Accounting standards are still evolving for these assets. Tax implications. Asset ownership creates tax considerations. Investment gains are taxed when realized or sold, with rates varying by holding period and income level. Some assets receive preferential treatment. Retirement accounts defer taxes. Primary residences can exclude significant capital gain, and certain exchanges allow deferring recognition. Estate taxes may apply when transferring assets at death. Strategic asset positioning and timing can dramatically affect after-tax wealth accumulation. Asset protection. Legal structures can protect assets from creditors and lawsuits. These include trusts, limited liability companies, retirement accounts, often protected in bankruptcy, and homestead exemption. Insurance protects against asset loss from disasters, liability, disability, and death. Economic significance of an asset. National wealth represents the sum of all assets owned by a country's residents and government. The United States' total household net worth exceeded $140 trillion in recent years. Asset distribution significantly affects economic inequality. The wealthiest 10% of Americans own roughly 70% of the country's wealth, primarily in financial assets and real estate. When it comes to asset bubbles, prices become detached from fundamental value. They have caused economic crises throughout the Dutch tulip mania in the 1630s, South Sea bubble in the 1720s, the 1929 stock market crash, Japanese asset price bubble of the 1980s, and the dot-com bubble of the 2000s, and not to mention the 2008 housing crisis, all involved asset prices rising unsustainably before collapsing. You're not going to want to miss what's next, and they did not teach you this in school.